actually good morning from sunny London today. That's super exciting because the sun is shining and that makes me extremely happy. So we are in episode 3 of the financial statements series. So I want to touch upon today ratio analysis. Now, as a little recap, we have touched on all of the 3 different statements, the main statements that are expected of companies to be presented, and that is the income statement, which looks at your revenue and your expenses primarily. And then we looked at the balance sheet, which looks at your assets and your liabilities and equity, and finally the cash flow. Now today I want to wrap them all up together and kind of walk you through how they connect, because understanding each one of them independently and individually is great, but really you get the power and the benefit of understanding it as a whole picture. That's when you can really dive deep and understand all the different aspects of the business. And this is really interesting and will help, new beginners if you're just starting your own business and you need to present these statements. Here in the UK, it's guarded by the IFRS standards. In the US, it's GAAP, and you are expected to present these 3 financial statements at least. And if you are trying to, invest in the stock market and you want to actually go and look at these companies and their financial health and understand what you're looking at, it will also be quite useful to you. And you know what? Just in general, if you're looking to get some financial education and better understand literacy in finance, this will be very helpful for you. So let's get to it. If we start from the income statement, which is kind of where everything happens. If you think about it, the flow of things is you have a product, you buy it, you spend money on it, that's your expense. It becomes an inventory, that's an asset, and you then are able to sell it, you get some money, that is revenue. Do you recognize it, or is it all cash? Like, what portion of that? It's important to also understand that, if we look at, for example, a subscription-based model, if you receive, let's use 100 or 120 for this purpose as an example, and your client is a subscription, so they are paying you this lump sum of money, but it is for 12 months. As a revenue, you can only recognize 1/12 of that revenue. So 1 month, that first month, when you're doing the P&L of that month. But on the other hand, what is the cash that you're receiving? Maybe they went on a payment plan for 3 months, so they're paying you in cash in 3 months. So you see how the sale is one number, the revenue is another number, and the cash is a different number. So it's important to actually be able to understand these things when you're looking at the financial statements. And an interesting way of doing that is by looking at these ratios. So for example, the main ratio that you might want to look at when you're looking at the income statement, your profit and loss statement, is the profitability ratio. And what this does is basically takes the revenue or your margins as well, which would be the difference between your revenue and your expenses divided by your revenue, and that will let you know what your profit margin is. What is the percentage that you have made and earned on your revenue. You want to make sure, obviously, that you are profitable, that you are making more revenue than expenses. And then on the balance sheet, you want to compare your assets to your liabilities. You remember, assets are things that you own. For example, we just touched on inventory, cash is an asset, and versus your liabilities. You want to make sure your liabilities are obviously your debts, your obligations to your suppliers, and etc. You want to make sure that you have enough money you have enough assets to cover those liabilities. And we look at it as the current assets and liabilities, meaning the ones that are within the first 12 months, the next 12 months. So to make sure that you are able to transform these assets into cash when necessary to be able to cover those obligations as they come along. And then the third one to look at, which would be kind of on the cash position, is to, look at your cash. If you remember, cash goes from taking your net income from the P&L and then working your way back, as we just touched on, to understand of that revenue that you've recognized and the net income, how much of that is actually cash, because there are a lot of aspects that are not necessarily cash. So you want to understand what is actually sitting in your bank. You want to look at the difference between what was in the bank at the beginning of the period and what is in the bank at the end of the period. The cash flow is divided into three main sections. The cash from your operating activities, from your investing activities, which is like buying, capital. So things that, I don't know, if you have a factory and you need to buy heavy machinery that's going to last you for 5 years, that would be something that you have invested your money in. And finally, your financing section, which is if you've received a loan or any cash lump sum, that would be in your financing section, as well as if you've paid off any of those debts. And yeah, you want to make sure that you have enough cash in there to pay any upcoming obligations as well. And yeah, so I think that is basically tying all the statements together. I hope it's helped you clarify some things, and if you have any questions, feel free to definitely get in touch and leave a comment, and I will get back to you. Have a wonderful day.